Welcome to a journey that could potentially change your financial future. Today we're uncovering 20 common investing mistakes that may be affecting your financial growth. From having unrealistic expectations to not diversifying your investments, these mistakes could be the stumbling blocks in your path to financial prosperity. But don't fret. By acknowledging and understanding these pitfalls, we can learn to steer clear of them. Ready to discover what might be holding you back in your investment journey? Let's dive in. Starting off with mistake number 1, expecting too much. It's crucial to maintain realistic expectations when investing. High hopes can lead to impulsive decisions and disappointment when the market doesn't meet those lofty goals. Instead, stay grounded and keep a long-term perspective without reacting emotionally. Moving on to mistake number 2, no investment goals. Without clear, defined goals, it's easy to get swept up in the latest market trend or short-term returns. This can distract from the bigger picture and your long-term financial health. To avoid this, establish specific, measurable, achievable, relevant, and time-bound or SMART goals. Next up is mistake number 3, not diversifying. Putting all your eggs in one basket is risky business in the world of investing. If that one stock plummets, so does your entire portfolio. Diversification helps spread the risk and offers a safety net. On to mistake number 4, focusing on the short term. Short-term market fluctuations can cause anxiety and lead to rash decisions. It's easy to second-guess your strategy when things get rocky. However, investing is a game of patience. Stick to your strategy and remember it's about the journey, not the destination. Finally, we have mistake number 5, buying high and selling low. It seems counterintuitive, right? But in the heat of the moment, when the market is soaring or plummeting, many investors let their emotions guide their decisions. This often results in buying stocks when prices are inflated and selling when they're low, which can hinder overall performance. Remember, investing is not a sprint, it's a marathon. Keeping these common mistakes in mind and learning how to avoid them can help you navigate the investing landscape with more confidence and success. Moving on to our next set of mistakes, beginning with trading too much. Trading frequently might seem like a proactive strategy, but it can actually be a pitfall. Did you know that the most active traders underperformed the US stock market by 6.5% annually? Make sure you're making informed decisions, not just frequent ones. Next up, we have paying too much in fees. It's easy to overlook fees when you're focused on returns, but they can significantly impact your overall investment performance, especially over the long run. So always keep an eye on what you're being charged. Number 8 is focusing too much on taxes. Sure, tax loss harvesting can boost returns, but making decisions solely based on tax consequences may not always be the best strategy. Always consider the bigger picture. Our 9th mistake is not reviewing investments regularly. It's important to check in on your portfolio periodically, whether that's quarterly or annually. This helps ensure that you're still on track with your investment goals and allows you to make any necessary adjustments. Finally, we have misunderstanding risk. Finding the right balance of risk is crucial. If you take on too much, you might find yourself outside of your comfort zone. But too little risk may result in lower returns that don't meet your financial goals. Understanding your personal risk tolerance and aligning it with your investment strategy is key. Now, before we move on, let's take a moment to reflect on these common mistakes. Trading too much, paying too much in fees, over-focusing on taxes, neglecting to review your investments, and misunderstanding risk. By recognizing these pitfalls, you can better equip yourself for a successful investing journey. Remember, the key is not to achieve perfection, but to continually learn and refine your strategy. Keeping your eyes on the prize will help you avoid these common mistakes. We're halfway through our list. Let's uncover mistake number 11, not knowing your performance. It's surprising how many investors don't actually know the performance of their investments. It's important to review your returns to see if you're meeting your investment goals, considering all aspects such as fees and inflation. Moving on to mistake 12, reacting to the media. Negative news in the short term can trigger fear, leading to rushed decisions. Remember, it's crucial to focus on the long run, not just the present moment. Now, on to mistake 13, forgetting about inflation. Historically, inflation has averaged 4% annually. Imagine having $100 and after 1 year, due to inflation, its value drops to $96. After 20 years, it's down to $44. It's essential to factor in inflation when planning your investments. Next up, mistake 14, trying to time the market. It's a common misconception that you can outsmart the market by buying low and selling high. But the reality is, market timing is extremely hard. Staying in the market, despite its ups and downs, can generate much higher returns versus trying to time the market perfectly. Finally, we reach mistake number 15, not doing due diligence. It's easy to trust the person who's handling your investments, but it's necessary to do a background check. Websites like BrokerCheck can help you verify the credentials of your advisor, their employment history, and any complaints filed against them. So there you have it. Mistakes 11 to 15 all emphasize the significance of being aware and informed in the investment world. Remember, it's not just about making investments, but also about understanding them. The more knowledgeable you are, the better your chances of avoiding these common pitfalls. Knowledge is power, especially when it comes to investing. We're down to our last 5 mistakes, starting with working with the wrong advisor. Just like in any partnership, the relationship with your advisor should be based on trust and aligned interests. Taking the time to vet your advisor carefully can save you from unnecessary headaches down the road. Next, we have investing with emotions. It's natural for emotions to run high during market fluctuations, but remember, rationality should be your compass in these turbulent times. Making decisions based on fear or greed can lead to costly mistakes. The 18th mistake is chasing yield. High-yielding investments may seem attractive, but they often carry the highest risk. It's crucial to assess your risk profile carefully before investing in these types of assets. Remember, high reward usually comes with high risk. The penultimate mistake is neglecting to start. Consider this. 2 people invest $200 monthly with a 7% annual rate of return until they're 65. The person who starts at 25 would have a portfolio worth around $520,000. While the one who starts at 35 would end up with roughly $245,000. The earlier you start, the better. And last but certainly not least, not controlling what you can. While no one can predict the market, you can control small contributions over time. These small contributions can have a powerful outcome. It's like planting a seed and watering it regularly. Over time, it grows into a strong tree. Well, there you have it, the 20 most common investing mistakes. We hope this insight helps you navigate the world of investing with more confidence and fewer setbacks. Remember, the right decisions today can lead to a financially secure tomorrow. And there we have it, 20 common investing mistakes that could be limiting your financial growth. These pitfalls can seem daunting, but with knowledge and preparation, they can be avoided, helping to put you on a path to successful investing. Remember, it's not just about avoiding the mistakes, but also about understanding why they can be detrimental. Whether it's having unrealistic expectations, neglecting to diversify, or forgetting about inflation, each of these missteps can greatly impact your financial journey. Investing isn't just about making money, it's about setting goals, taking calculated risks, and making informed decisions. It's about understanding the market and not being swayed by short-term fluctuations or media hype. It's about doing your due diligence, finding the right advisor, and regularly reviewing your investments. In the end, what matters most is that you take control of your financial future. You can't predict the market, but you can control your actions. Small, consistent contributions over time can lead to powerful outcomes. It's never too late to start, and every step you take in the right direction counts. So let's turn these mistakes into lessons learned. Let's take these pitfalls and turn them into stepping stones towards a more secure, prosperous financial future. Which of these mistakes will you work on first? Share your thoughts in the comments below, and let's grow together in our financial journey.